Well, first, I would like to thank everybody for joining us today. And just a couple of housekeeping rules first. As you can imagine, everyone has been muted and their cameras are off. And we would ask that you put any questions that you have in the Q&A. I'll try to monitor that and give Tim the questions at the end of the presentation. So our speaker today is Tim Vannoy, and you wouldn't know it by his high level of energy, but Tim has 33 years of experience in the securities and insurance channels. He manages sales, client relationships, and distribution through multiple IMOs and BGAs. Tim has his CFP, his CHFC, his CL, and his CLU. Pardon me for a minute. Whoops, I'm sorry, but I have a clock that seems to insist upon chiming right when I don't want it to. Tim's been a member of the $1 Million Roundtable, Gamma, and Financial Planning Association. And best of all, Tim served as president of his local NAFA chapter. Currently, Tim is with One America, working, as I said, through IMOs and BGAs to grow the One America Care Solutions product line. One America is a founding sponsor of NAFA's Limited and Extended Care Planning Center, and we thank them for their continued support and for their overall support of NAFA in general. So what are we going to hear about today? How many of you are familiar with the benefits that the Pension Protection Act, PPA 2005, did the act help create an expanding market? What opportunities are there for you to turn idle policies into new revenue opportunities? Tim will share 3 case studies which illustrate how to turn tax-deferred policies, gains in those policies, into tax-free distributions. You probably have clients that look like those in these case studies. So with that, I turn it over to you, Tim.
Hey, good afternoon, everybody. And Carol, thanks for the kind intro. I'm going to start with this story. I think it's always great to start with this story, and I hope you see the tie back to that, to the conversation that we're going to have today. So a business owner walks into his factory and sees a 20-something-year-old guy standing with his hands in his pockets, staring at the ground. The owner asks him, "Why aren't you working?" The young guy says, "Dude, I've done my job. I just want to get paid." This enrages the business owner. He starts talking about the poor work ethic of this millennial. Really gets him into a fit of rage. He finally asks the guy, "How much do you make a month?" And the young man says, "About $1,000. The owner pulls out $500 out of his wallet, hands it to the young man, and says, "You're fired. Here's 2 weeks' pay. Get out of my shop. Don't come back." The young man leaves with the $500 in his pockets. A couple seconds later, the shop manager approaches the owner and asks, "Have you seen the pizza delivery guy? I had to go get change for a $20 bill so I could give him a tip." The moral of that story is make sure we know the facts before we react. So of course, he was not an employee. He was the pizza delivery guy, got the $500. And I hope that story kind of ties back to what we're going to talk about today as far as annuities and this Pension Protection Act, and how it hopefully will open up some new doors as you start to think about the planning process, especially as we start thinking about those folks in that retirement side of the house. So with that, we're going to talk a little bit about just a real quick overview. For some of you, this may be a refresher course. For others, this may be the first time you've taken a look at or known of One America. So we have the asset care product. That's a whole life with long-term care benefits. It's a hybrid product. We offer that in different flavors, so to speak, and we offer it both on a single and a joint chassis. So from an insured perspective. But today's conversation, I'm going to focus on the right side of the screen, our Annuity Care suite. It's a single premium deferred annuity that has some unique features with it as it relates to, as Carol mentioned, the Pension Protection Act. It is a long-term care, it's a qualified long-term care annuity. So we have our Annuity Care, our Annuity Care 2 product, and then the indexed Annuity Care. And those are the three solutions we're going to be talking about as we start looking at some of the case studies. As you start to think about people that might be in your book of business, so to speak. The last product I want to talk kind of at the bottom is our Legacy Care annuity. This is a non-PPA annuity. It's a very niche product for us, but it really serves a great purpose. In fact, I had a case earlier this year. A gentleman was 95 years old. He had outlived his annuity. And so the company was going to send him the distribution, all of the money, the basis of what he paid in, but also the gain, which was also going to be taxed to him. The tax deferral was going to come due. At age 95, he says, I don't want to pay the gain. I want to keep on deferring that if I can. And once again, the Legacy Care annuity, we issue that up to age 99, was a great solution for this client so he could continue to keep that tax deferral with respect to that product. So, and that leads me into a study that was done a couple years ago with Gallup. Gallup asked individuals that bought owners of non-qualified annuities, and they said, what was the motivating factor? What was the number one? Or can you tell me what was at the top of the list? Why did you like that tax deferred growth? Or they bought it because of the tax deferred growth. That's what they liked about it. And I can tell you from being my time as an advisor, I saw the same. I would go out and talk to clients about the ability to eliminate the 1099. I talked about we can get tax deferral as we go and get compounding of those dollars, so to speak. So that's a number one thing that when people look at these non-qualified annuities, it's really the tax deferred growth. In that same report, they came back and said, if you're not going to use this for income, what would it be intended for? And 3 out of the 4 individuals came back and said, it's an emergency fund. It's just in case money. It's there for a rainy day, or nursing home care, which kind of ties back into our Pension Protection Act. And that's what I want you to start thinking about, going back to your existing book of business, talking to your clients, thinking about those that have purchased these annuity contracts. And what's the intention? What do they intend to use the money for? So as we start here, I'm going to leave you with start thinking about maybe a couple questions we might ask. The first and foremost is, do you own the new type or old type of annuity? Now, when I've asked that of clients and we do some training about this, it kind of is a puzzling question, because when I ask that to a client, 2 things, the response is going to tell me a couple things. The first thing I'm going to hear back is, well, I don't own an annuity, so I don't know if I have the newer. Okay, they've just answered my question. They don't own an annuity. But more times than not, what I find is they'll come back and say, well, I don't know. What is my annuity, old or new? What would make the difference? And I'm going to go ahead with another question. What would cause you to spend this money? What life event? What has this money been earmarked for? And normally what I heard is that we hope we never have to spend the money, but I guess if we did spend it, it's because we're in a nursing home. Goes back to that Gallup study. 3 out of 4 people said it's just set aside. It's earmarked, probably going to the beneficiaries, going to my kids. But if we need care, mom or dad, that's where we're going to tap into. And so that's where I want to kind of leave this as a basis of our conversation. The core of our conversation today really focuses around that Pension Protection Act. It was 394 pages of legislation. About 3.5 of those pages allowed or basically addressed this conversation of tax qualified long-term care. As we know right now, 99% of all annuities look something like this on the left-hand side. I have my basis, which is non-taxable when I take it out, but any gain is going to become taxable to me. So as I put the money in, and maybe it's doubled over the time, Aunt Betty calls up and says, I'd like to take some money out of that for whatever reason. And every dollar that she takes out becomes taxable to her until she gets down to her basis. With the advancement of the Pension Protection Act, based upon how we filed those three products, the Annuity Care, the Annuity Care 2, and the indexed annuity, if it's needed for long-term care, and going back to some basic things from a long-term care perspective, it's a tax-qualified annuity. When we say tax-qualified, we're talking about the triggering of the 2 of the 6 activities of daily living or a cognitive impairment. If the individual has that, is experiencing that, and they have expenses associated with their care, they can receive the gain income tax-free, and of course their basis would follow income tax-free. But just think for a moment right now, going back to that Gallup study. The reason I bought it was because I got tax deferral. And now we can share with a client a way to take the money out tax-free. There's no other way that I'm aware of today that I can tax defer something over a period of years. And then when time is needed, if I do need that care, I can pull that money out income tax-free, never pay tax on that gain. What a great planning opportunity for your clients. As we've exhausted the annuity care, as I look at it, I kind of think of a bucket of money. We use their money first, so to speak, and that money drains out income tax-free. If with our products, we can offer what we call a continuation of benefits rider, which is an additional leverage of coverage. That continuation of benefit rider can also be for life. So we can continue on that long-term care benefit, not only for the duration of their money, but for the rest of their life, whether they needed care for 8 months or 8 years. So I started looking at the numbers, and it's one thing for me to talk about the tax deferral and the tax-free out. But I thought, a great way to do this is let's look at an example. So let's take Aunt Betty. She bought an old annuity. I call it the old annuity, a single premium deferred annuity some years ago. She put in $50,000. She's now 72 years old. We looked at her statement. It's worth $100,000. She's doubled her money. She likes the idea of the growth. More importantly, she likes the idea that she's getting 3% guaranteed on that contract. So as I've kind of done a little showing you here on the illustration, we're just going to continue to keep that 100,000 growing at the 3% compound. And about age 80, she or her husband, Uncle Wayne, starts to have some deficiencies and they're going to need some care. She calls up to the insurance company and says, would you send me 1/3 of the value? Could you just send me out a check for 1/3 of the account value? Because that's going to help us pay for our care. The insurance company sends her a check for $42,000. And then of course, next January, she's going to get a 1099 for that $42,000. She probably is thinking, yeah, I'm going to have to pay some taxes, but she's starting to think about what is the tax impact. And this is where I want to talk about with our clients. State, federal, local taxes. If she's in the 30%, if we add all that together, there's a $12,000 tax liability. She nets out $29,000. The second year, still needing care, $42,000 is paid, $11,000 is taxable, or the tax liability, $30,000 is the net. Finally, the third year, she's into her basis. It's her return of her money. So there is no tax due. When we add it all up, she nets out about $106,000. $24,000 was paid to the Internal Revenue Service via the taxes. And from a planning perspective, we always talk about state, federal, and local taxes, but I want to talk about the silent tax. See, because when she takes that $42,000 out, that becomes ordinary income to her. That now becomes what we call provisional income, which will impact her Social Security. She hadn't thought about that. She looks at her tax return and she says, why is more of my Social Security tax this year than it was the year before? Provisional income. It kicked her into another bracket, more of her Social Security for her and her husband. She may find out that now some of her capital gains is being taxed. Under current tax laws, she can have up to $80,000 of income and not have any capital gain, but maybe their retirement plan is they're selling some units of mutual funds. And by doing that, it's now pushed her into a capital gains bracket. And last but not least, there's the Medicare Part B and D surcharges. So when you start looking at the taking the money out of that old annuity and the tax drain or the what's happening with respect to the taxes, a lot of planning is done around state, local, and the federal side of that. But I want you to focus on those silent taxes as well, the provisional income, the capital gains, and the Medicare. Now on the right side there is our Annuity Care base contract, 1.25, and you're saying, okay, that's okay rate, but she was getting 3 before, but let's just kind of run the math and do the same situation. What happens as we go down? Age 80, we're about 110,000 in value. She calls up and she finds out that they would qualify to be on claim because of either the 2 of the 6 activities of daily living or a cognitive impairment. They're going to receive some care in their home for one of them. And we find out that we're going to pay out about $3,200 a month or $38,000 a year. But the key part of that is it's tax neutral. There is no federal, state, or local taxes. And of course, with that without those taxes, there's no provisional income, capital gains, or Medicare. And that becomes the conversation I want you to have with your clients. Are you aware of the tax liability that's created in the old annuity? And if planning or a need for care does this work, and we're just talking about our base only contract here. As you can see, as she receives the payments out over the period of the 3 years, she nets out 115,000 versus the 106. Yes, she's going to make more even though she earned less, but her whole focus was going back to what would cause you to spend this money. Her whole focus was, if it's needed for care, earmarked for that. So just think from a planning perspective. And when I've done this before with clients, if you've ever had to deal with working with a family, maybe a family member needing care, it's an income conversation. It's never an asset conversation. Income pays for one's care. So I've used this and I just summarized it here. Usually it's 1 through 10. But let's look at there. It says, if my monthly income is insufficient to cover my extended care needs, please liquidate my personal assets in the following order. Have you ever asked the client what asset they would sell first, second, and third? I've used this sheet of paper and I've given that to client. I said, in the event that you decide not to fund your extended care plan, at least let your family know what your wishes are with respect to what asset would be sold first, second, and third. The other option is the insurance contracts, right? The long-term care products that would fund the plan. But in the absence of that, and they decided to self-fund or self-insure, maybe we should let the family know. And my suggestion to you in this situation is, if they have that old annuity, more times than likely, they're going to tell you that that's going to be the first thing we're going to liquidate. But we talk about the tax. So I'm going to say, if it's a pension protection annuity, let's put that tax favorable status on it to eliminate the tax lien. And yes, I use the words tax lien because that's what it is. It's tax deferred, but I'm never going to get rid of that tax lien, so to speak, unless I use it for my care. And you can't get to that without a Pension Protection Act qualified annuity. If that's not enough income, maybe the second bucket or spigot of income that we need to get into is an IRA. Once again, causes provisional income, causes additional taxes. Has the client thought through what would happen if I had to take out an extra 10, 20, or 30,000 out of their IRA? We go into non-qualified mutual funds. Maybe the estate plan, the legacy plan that the client had was, well, I'm going to just take the dividends off of those mutual funds. But if I need to start selling those units, I've lost the ability to pass that stepped up in basis to my beneficiaries. Once again, trying to be legacy planning, tax planning. Last but not least, maybe it's a piece of real estate. Maybe it's the farm. If I have to liquidate, sell that piece of property, now I have capital gains and I've lost the ability to pass that as a legacy, but also pass on that stepped up in basis to the next generation. The whole goal is to give them the stepped up in basis at death. Of course, that would not occur if I needed to liquidate the position. So it's a liquidation order. And if they have that old annuity that's sitting there kind of collecting dust, it's going, gee, I have that 3%. I really like getting that. Never going to spend it. What happens if I decide to reposition some or all of it into a Pension Protection Act annuity to provide that long-term care, that extended care planning, or funding my plan in a very tax efficient manner? So with that, I want to talk a little bit just at a high level, the differences between our annuity care and the indexed annuity care product. As you'll see there, our indexed annuity care, or I'm sorry, our annuity care product, we can issue that up to age 87. Indexed care goes up to age 85. We can issue that on a single or joint life chassis. Now, and I say that when we can add both mom's annuity and we could add the spouse to that, they both have to go through whatever underwriting requirements would be there, but we can add that person into the contract and they can also have access if they need care and get it out income tax free. 1035 exchange or cash is what you would be looking at. And as you can see, there's some of the states that we're not licensed in for the products. Here's the key to this process and these types of solutions is underwriting. Most products in the marketplace today require some type of a phone interview, requires some type of medical review, requires maybe a cognitive screen. Maybe your client has aged out of a product. Maybe they're 83, 84. Earlier today, I got a case on my desk. 83-year-old female, now looking at long-term care, $125,000 in an old non-qualified annuity. The renewal interest rate is less than 1%, and the current value today is $165,000. This is a great solution for that client in the fact that there's no phone interview. There's 5 knockout questions. I'll share what those are here in a minute. We do a prescription check and an MIB check on the back end just to make sure that there's nothing in the file that would cause an alert. And if you think about your target market for this space, those that are between the ages of 78 and 87, they have those old annuities. There's trillions of dollars sitting in old annuities. One way for us to diffuse that time bomb, it's earmarked for their care. Let's put it into some type of a Pension Protection Act annuity for that. These clients have large gains, and it's just in case money. When you ask that, once again, we're probably never going to use the money. It's going to go on to our 3 daughters, but if we did, it's because we're in a nursing home. Of course, the coverage today doesn't matter whether they're in a nursing home, assisted living, adult daycare, or in their own home, where most people like to receive their care. So once again, we start looking at that, and I just want to talk about the 5 knockout questions. So our base contract only, no phone interview, but we do ask these 5 questions. So there are some medical hurdles. The first one is, do you use any of these mechanical devices, such as a wheelchair, walker, dialysis? If they say yes to that, they're not going to be eligible for our coverage. Do you currently need help doing any of the following: bathing, eating, dressing, toileting, the ADLs? If you're currently receiving or needing care for those services, it's too late. Do you currently have or you've been diagnosed or treated for dementia, Alzheimer's, multiple sclerosis, MS, ALS, Parkinson's? If so, not a good fit for you. Have you ever been diagnosed with AIDS or HIV? And the 6th, or the question number 9 here, the 5th question in this, only applies to the indexed annuity. But it says, are you currently receiving or have you received Social Security disability income benefits in the past? If a client can answer no to those 5 questions, we pass the prescription and the MIB on the backside that we do behind the scenes. We can now provide a product and coverage for them with respect to the tax leverage. So this is the indexed annuity product. I'm going to give you the example here. We have a single female, age 70, She put in $50,000 into the contract, and now it's grown to $150,000. She's thinking about some planning. Maybe she was turned down by a traditional coverage, or maybe even a hybrid product. She did not qualify based upon maybe some health conditions. But she has this old annuity, been earmarked, not needed for income. And in the indexed annuity product, she puts in the $150,000, and day one, she has $6,300 in monthly coverage, $75,000 a year. We're going to accelerate that over that 24-month period. Think about the tax leverage. So there's no state, federal, local taxes. We don't have to impact her Social Security, no capital gains, nor the Medicare Part B and D surcharges. So this is a pure tax leverage play, thinking about how she might get access to this money as it relates to the coverage. So let's look at the illustration here. Let's kind of fast forward. As I mentioned, she was 70 years old. Let's go down to age 85. She passes away, just like any of the other annuities. The $179,000 is paid as a beneficiary or to the beneficiaries. And once again, they would still pay tax on any gain that's inside the contract. Conversely, at age 85, she starts needing some care. On the right side, that second column to the last, her long-term care benefit balance has grown to over $206,000. Now, this is on our index product, and inside this product, we have a guaranteed multiplier. So regardless of investment performance of the S&P 500 strategies that we use, I'm going to have a guaranteed step up every year, year over year, on our long-term care balance. A little bit of a hedge against inflation. Once again, she needs care. $8,600 is available on a monthly basis. If she needs care for something less than the $8,600, we'll just basically go longer than the 24 months. We'll may go out 28, 29, 40 months based upon how she drains or how the benefits get paid out. Either way, live, die, or quit, she's going to get something back out of the contract. She decides at age 85, I don't want the money, I'm moving to Costa Rica. That's fine. She gets the $179,000 back in cash. She can annuitize it. She can take 10% out. She enjoys all the other benefits and features that you would expect in any other type of annuity, with the addition of that long-term care portion. So she really hasn't given up anything. In fact, I believe she's gained more because of the protection side of the house. Now I'm going to change gears a little bit. Some of us, maybe a broker dealer does not allow us to sell an index product, and this is more of a leverage play. So I'm going to talk about our Annuity Care 2 product. Similar to what we talked about in the index product, the base contract is accelerated on a single life over 24 months, 30 months if we add the spouse. Issue age is up to age 80, so a little bit shorter from a duration perspective as far as underwriting goes, as far as the age. Single or joint, it's a fixed deferred annuity. Everything inside the contract is fully guaranteed. The uniqueness with this product is we've added what we call our continuation of benefits rider. It's bolted together. It comes as a package. So once I've exhausted my 24 months of coverage, my money, so to speak, now I'm basically over using the money of One America. And they're going to continue to pay out that monthly benefit for an additional 36 months. Pure leverage. For every dollar I put in, I get $2.50 back tax-free. That's key to the contract. It's built in. You cannot unbundle it. You can't unbuckle it. It has to be, it's bolted together. Because I've included that continuation of benefits rider in the contract, it does require a phone interview. And if you're over 60, cognitive questions as well. But we're not going to ask, there's no paramed, there's no labs, there's no exam. We're going to either do a thumbs up or thumbs down based upon the phone interview. But it's a nice package sale for that person that likes the leverage, goes through the underwriting process. That continuation of benefits rider can be added to the other two products, the index product, and it could offer a lifetime benefit, by the way, as well as the Annuity Care product. So it is available as a rider. It can be added or subtracted. In the prior example with the indexed annuity, I did not include it because I just wanted to show how simple it was with our base contract. So let's look at an example here. a 65-year-old female. As we start to think about this, $100,000 repositioning could be coming out of an existing annuity or a cash position. In this situation, the base would be accelerated over 24 months, so $4,100 a month in benefits. $50,000 is back to her. Once we've exhausted her money, now we're with the One America companies. Now they're going to be on the responsibility, on the hook, so to speak, for the additional $150. We're going to continue to pay that $41.65 each month until the duration of the claim has been exhausted or the termination of the claim. Pure leverage play there, puts in $1, she gets $2.50 back out, income tax free. It does require a phone interview. The underwriting is much more liberal than our life product. So if you do have those cases that might not have qualified for the hybrid product, maybe this still get some of that long-term care protection as well. As I mentioned, we can add a spouse. They would go through the same underwriting process as the primary insured. So think about where we have that annuity where somebody was the owner and the annuitant, and now we want to add the spouse. But sometimes when we do that, we don't want to violate or cause problems with 1035 exchanges. And so we add them as an eligible insured, still keeping the contract and the 1035 rules in play. So from a illustration perspective here, you can see that the 65, the 100,000 is deposited, and on the very far right side, the 250,000 is in long-term care. The 41.65 is the monthly long-term care contract. Just in case there was any, we are a reimbursement product. So this is a reimbursement of expenses. And I'll touch on that here in a minute when we get into the claims aspect as we kind of wrap up our conversation. There's going to be times that you're working with clients and you may be thinking of clients that you have today that said, this sounds great, Tim, but I don't know if we want to give everything to this concept. Maybe there's a part of it. Maybe we could just, as I call it, the split annuity. Could we divide the existing annuity and still get some of that long-term care protection, but still keep some back for gifting, maybe future income? And the answer is yes. So the example here is we have a client that has a value of about 300,000, 200 in basis, 100 in gain. When we shared this idea with him, he loved the idea. He says, can I give you 150,000? And he really wanted to give us all 100 gain. It doesn't work that way. It's proportionate. So we got the $100,000 back in the basis, and we took 50,000 of the gain, and we were going to put that into the Pension Protection Act annuity. He wanted to leave the other 150 where it was at, because he had some future needs that he was going to possibly use, and he had some gifting that he was going to use that to fund some gifting ideas. The problem was at that time is that the current company that had all 300,000 would not allow for a partial 1035. We will accept a partial 1035. It just wasn't that that company was set up to do partials. So in that situation, we used our annuity transfer process. We still kept the opportunity, so we 1035 the entire amount to One America as he wanted. He wanted to keep 50% of it with us, which we did. We funded his solution. But he worked with his advisor and he found another product that would be suitable based upon his income needs and his gifting strategy. And so what happened was we sent the other 150,000 to a second carrier. So we can facilitate the partial 1035, we can process the money, and then we can send it on to a third carrier if need be, and still keeping everything through that wrapper of the 1035. So we will always take partials, but if the company where the money sits today does not allow for that, we can help process that and still keep the coverage in force that they were looking for, and trying to make lemonade out of some lemons, so to speak. So with that, I'm going to kind of wrap up. My time is getting close to being at the top of the hour, so I want to make sure respectful for everybody's time that's on the call. Just a couple of things from a One America perspective and kind of what sets us apart. As I mentioned before, we offer both fixed and indexed, so you have both options to pivot to. We have a base contract as well as the continuation and benefits rider, very, very dynamic as far as how you can customize that to your client. I mentioned before, we have the joint life and the single life option available to you. So depending upon your planning needs, we can take care of that. The benefits that come out of these contracts because of the Pension Protection Act is that income tax free. I just shared with you the partial 1035 exchanges and how we can facilitate and help you in that with your clients. I want to stop for a second and talk about claims. One America takes great pride in our claims concierge service. So a little backdrop on that. First and foremost, One America, as you can see here in my backdrop, this is a picture of downtown Indianapolis. That's the tower downtown. If you're watching any of the NC2A men's basketball, it was held there in Indianapolis. Sometimes you saw some shots of the tower as they were kind of doing some flyover shots of downtown. But the key part of that is our claims people are also based in Indianapolis. When a claim gets started, what's going to happen is normally it's a family member or somebody calls into our company and gets a claims packet. At that time, we're going to assign that case to one of our claims concierge claims professionals. Person based in Indianapolis, and when the packet goes out, what's unique in there is their business card, their direct line, their email address. That family will deal with that person from start to finish. That gives the family peace of mind that they don't have to tell this story again and again. And what happens is the claims concierge professional starts to build a relationship with that family. They know what's going on. They become an extension of that family. And I think it's a great lifeline, so to speak, to that family, because if you've never dealt with these types of situations before, where do you start? How do I process? How do I get services? It's kind of a mystery to everybody. And to have somebody at the other end of the phone that does this day in and day out, but is also assigned to their claim, is so critical. And that's the promise we make, making sure that that family is taken care of. And this is really a family conversation, no doubt, because mom and dad's going to get the care they need. It's just a matter of who's going to provide it. So having the claims concierge service is so critical to that. And I can't speak highly enough as far as our claims concierge team goes. And knowing that when you sell these types of products or offer these types of products to your clients, that when something happens 5, 6, 10 years down the road, they're going to be well taken care of as it relates to those pieces. The last one there is, of course, I said on the base contract, no telephone interview. I think that there's a great opportunity. I think there's going back to those clients that are late 70s, early 80s, asking them if they have the new or old type of annuity. What would cause them to spend this money? When you're doing renewals or annual reviews, you're talking to them about maybe that annuity. Ask them what would cause them to spend that money. Find out what their plan is. And from there, start to develop a plan, talking about maybe a little bit of the tax liability, talk about some tax strategies, introduce the Pension Protection Act. Would you be interested in finding a way we could eliminate the taxes? I was talking to somebody 84 years old, and I asked her, I said, when we got all kind of done, I says, what's caused you to look at this? And she said, well, we got to thinking that we should start thinking about long-term care now. Now, most people, I kind of laugh because I'm thinking 84, 85 years old, and now you're thinking about it, which is great. But the other thing is she goes, I like the idea of that there would be a check each month coming in. See, it's not the return. She didn't care how much bigger the bucket was going to be. It was not how big it was going to be. It's how can I efficiently get it to the next generation? How can I efficiently transfer? And when we talked to her about the tax lien and the taxes, she said this would be a great way for us to reposition some dollars, have that tax favorable basis based upon the Pension Protection Act, and be able to get at that money. That'd be the first thing we would turn on so that we don't pass that tax lien, that tax liability to our kids. So with that, I'm going to wrap up with respect to this. If you'd like to learn more about our products and solutions, there's an 800 number back to our home office. If you'd like to know more about One America, oneamerica.com. I also want to share with you a microsite. It's called Asset Based LTC. Great little site. It has some client materials. It has a cost of care calculator. What does it cost for care in my community? some marketing materials. If you're a financial advisor, it's going to ask you that, and some things open up. So a great little resource for you. No password, nothing like that. There's even a quick calculator. You can go out and calculate some long-term care coverages for your clients if you want. So 3 different ways you can reach us. We love the partnership with NAIFA. This has been a great partnership with us as far as this type of solutions. And we're excited for that, not only the NAIFA, but also just with this community that we have here today, learning more about this extended care planning and how this might fit with some of your clients. So Carol, with that, I'm going to kind of pass it over to you and see if there's any questions we need, and or kind of just, I'll toss it back to you at this point.
Okay, thank you. We do actually have one question. It's how can, if possible, tax qualified assets be used for LTC expenses in a tax efficient way?
So tax qualified. So we're talking IRAs,
right?
401k, tax qualified money, and we do accept that money. Now here's the key with that, right? So we can, I wish, and it's not available today, but the Internal Revenue Service says you can continue the deferral, but if benefits were ever received, it's taxable at the time of claim. So there's no way to take a taxable IRA, put it into one of the PPA products, and get it out tax-free. I mean, if that was the case, we'd have people lining up at my door. So this would be Starbucks every day at 8 o'clock getting your coffee, right? 8 deep in the line. That's not the case in that situation. So I can't take the examples we talked about today are all about non-qualified after-tax money. Now within One America, unique to our product solution, and we do offer a couple of tax qualified solutions using taxable dollars, IRA dollars, so to speak. But the distribution comes out over a period of 10 years. So the client's going to pay tax on the distribution over those 10 years. And ultimately, they're going to fund that asset care, that life and life hybrid product. So that is a solution we have. Very successful in the market. It's a great product because we offer a 20% income bonus on that. We'll issue that up to age 80 as well, by the way. So we got a long runway. The other product is the indexed annuity product. We can take an IRA rollover, put it in there as the base, but then normally what the client does is they buy the continuation of benefits rider. And when they add the continuation of benefits rider, they pay for that out of pocket. Think of a high deductible or a stop loss plan where I'm going to use my IRA to pay for my need for care. It's taxed when I take out my benefits for the first 24 months, going back to the example we used. But if she added the COB rider, she could pay for that out of her cash flow, out of her income. And then once we pay $1 out of the COB or the continuation of benefits rider, that's 100% income tax free. So high deductible plan would be the solution there. But we would accept both. It's just a matter of the plan. So great question.
Yeah, I think so too. With that, I will say that is the only question, but as you said, a very significant one. And at this point, Tim, I've learned, I always learn something when I listened to one of your One America presentations. And this was very, very informative. So we thank you, and we hope to have you back at some point in the future.
Very good. Hey, appreciate it. Thanks, everybody. Have a wonderful balance of your Wednesday. And yeah, once again, appreciate everybody jumping on and giving One America the opportunity today to present to your great organization. So thanks again.
Thank you.